Welcome back. In the green now for the benchmark indices. Reliance Industries is contributing on the way up. It's up close to about 1.5%. And IT stocks, they've been the laggards this year, but you are seeing a return of these IT names over the last couple of days. Tech Mahindra, Infosys have nudged up to a near 2% gain. The next corporate on our radar is MedPlus Health. The revenues have seen about a 13% rise sequentially in Q2, but margins contracted due to higher losses in the diagnostic verticals. The company also added nearly 350 stores in the September quarter, which is nearly 1.5 times the usual quarterly run rate. Gangadi Madhukar Reddy, the MD and CEO of MedPlus Health Services, is now with us on the show. Morning, this is Rima here. First, if you could tell us what is the current discounting which has been offered by you, and also the industry per se of e-commerce pharmacy, and is it normalizing?
So we've always been a value player in the whole pharmacy retail market, and our discounts actually are the highest for any offline and brick and mortar kind of stores. For all bills above 1,000, we give a 20% discount, and for bills below 1,000, we give a 10%. And the overall discount, as you can see out there, is around 16.5 to 16.7%. Given that 60% of our sales happen to people who are buying above a 1,000 rupee bill.
No, fair enough. So that we know, what happened in Q2. But if you could tell us, is there a potential that the 16.5% of average discounting could come down going ahead? Generally, what is the movement that we're seeing in the industry when it comes to discounting?
Unfortunately, discounts have only one way of going. They never come down at all. So no, whatever discounts we have set in our company, we set with the firm this thing that they are never going to come down. We expect to actually make money at this level. And the way we will expand the margins as we go forward is both, because of scale, which will reduce the overall cost of management at the corporate as well as the warehousing and all, and also by the product mix. Every 1% of private label increases our overall margin by around 0.4%. So that's the way for us to actually do it. I don't think, we will end up actually going back on the discounts. That's one. And I don't think the market itself is also going to do that. We have at least 3 players out there on the online side who continue to go hard on the discount at around 25% for the first 3 purchases, which actually means, for all practical purposes, most people end up actually taking advantage of various people in their families to buy, they make the first 3 purchases last forever. So as of now, I don't think, neither us nor the market is actually going to let up on the discounts.
5% discount on the first 3 purchases. I mean, where do you find these offers? I would love to get these. And you're saying, you said they tend to make these last forever. You mean, what do you mean? I mean, you hop getting discounts from each player.
Yeah, that's right. So, it's for your first 3 purchases, but then you can always go and, get it in some other family member's name, right?
Right?
So 1, 2, 3, you basically do that. And then before you know it, there's some other player who just wants to, do some more land grabbing, and he comes and offers the same. So you can just keep switching between members of family and between companies to keep the 25% forever almost.
Right. So you said discounts have only got one way of going, which is higher, and you said they'll never ever come down. I mean, and you expect to make money at these discount levels, but would you need to increase the level of discounting, sir, given what's happening in the marketplace?
No, I don't believe that at all. Given that a very small portion of the overall market, which is actually, now controlled by the online side, that is doing the discount. We're not really overly concerned. Online at best has a 3% to 4% overall market share in the country. And even in cities in which they are strong, they have between 10 and 15. But the fact of the matter is that 85% of the market still lies with the offline brick and mortar business, and of which, we have the best discounts. So as long as we are ahead of the pack on the rest, I don't think we are, going to go and change our discount policy anytime soon.
Hi, Mr. Reddy. At what level do you stop making money? At 16.5% discount, you're making money. At what level, do you say that of discounting will it start hitting you all? If you could give us a sense on that. And also, you spoke about private labels. That's going to be the margin driver, right, going ahead. And a couple of brokerages, they are betting on that contribution going up. So where is that one headed?
So last quarter, we showed a number of around 13.9% overall private label. out of which around 8.7 to 8.8 is in the pharma side. So we will continue to grow that. I can't, hazard a guess on that, but, it's fair to say. So we have, in the past, from 2019, we have grown from 4.5% to 13.9. I expect that we will show 100 basis points kind of increase every year. So that is on, pretty much on. That is guaranteed almost.
Sorry, 13.9% share of private labels.
That's right.
And that will go up 100 basis points every year. Got that. Go on, sir. Sorry, I interrupted you.
That's one. And second, on the discounts, I don't think, given that we don't see any problem at all in continuing our market share and in keeping up our market share without having to increase discount, I don't think there's any point at which we'll actually start losing money at all, because we're not intending to increase the discount no matter what. This is basically the 16.7 or 16.8 is there, and that's a function of what we offer to the customers. We don't see any problem with with holding out the market share at that number.
So your store addition in nearly 350 is significantly higher, and now you're expanding in the tier 2 cities. Isn't it harder to break even in tier 2 cities given the overall ticket size tends to be on the lower side? And is there any guidance on the addition?
Yeah. So we actually guided to 1,000 to 1,200 stores in the year. And in the first half, we have added around 600. We'll most likely add about the same number for the rest of the year. I don't think we're really going to step up the overall number from that 1,000 to 1,200 kind of thing. And in 1 or 2 quarters, it goes up and down a little bit. It also is a function of how fast we can get some of the work done and how fast can we get the licenses in place and all. So don't go by the 350 number too much. The guidance is more towards 1,000 to 1,200. And on the thing of going into tier 2 and all, tier 2, we have 7 states. We have a major presence in 7 states. All the warehouses are set in place, and we have a major presence in the cities, in the capital cities of these states. Now the next step for us is to go down to tier 2, tier 3, and tier 4 to maximize the overall efficiency of the supply chain. For us, that works beautifully. On the second thing about, ticket size being slightly smaller in tier 2, medicines are not exactly like a luxury kind of product out there. People have to buy them. There's not really that much difference. While definitely there's a small amount of, difference, I would say, not significant, A. And B, the overall cost of rentals, manpower, and also the better private label mix, which you see in a tier 2, actually helps us make more money in a tier 2.
Okay.
While the absolute number may be slightly lesser, the EBITDA is actually higher there.
Right. Mr. Reddy, I think we touched upon this last time as well, because your strategy is, you have to spend to expand, right? And eventually you get to a scale where, you become cash flow positive, etc. You start making, you become, much more profitable than you are currently with scale. But what's the strategy? Do you set up these stores independently? Do you take over running pharmacies, rebrand them, sort of let the owner, the existing owners run these places under your brand? Can the process be fastened? Yeah.
No. See, almost all the stores which we take up are greenfield. We lease the store, we build them out, we have our own employees. It's a company-owned, company-run store. Now, the market says that we are actually going too fast at 1,200 stores a year. We could definitely go much bigger if we would needed to, but I don't think we want to test that at this point of time. We are happy with the pace at which we're growing. So we believe that in a market like pharmacy, retail, and all, where the margins are really low, there's not really enough margins for us to do a franchisee or get in some other partner or someone like that. So for us, company-owned strategy works very well, and we are 100% capable of actually growing at the pace at which the market can take it. So that's one. On the second thing, yes, our store, we are growing fast, and we will see a margin expansion as we go forward, because our stores basically start delivering the full EBITDA at the end of the second year and are between the 24th and the 30th month. Given that 50% of the overall network right now is under 2 years, we are seeing a little bit of drag, but that's the only reason. And even then, we're far from making losses out there. We actually make money. So that's not a problem at all. We can grow profitably.
Sorry, at the end of the second year, a store turns?
No, the store actually turns profitable within the 3rd to 6th month only.
Right.
But the full EBITDA, the full EBITDA potential which is realized, is only realized.
Okay. And you're saying 50% of the network right now, operational network right now, is less than 2 years. So that's
less than 2 years. Yeah.
All right, got that. Mr. Reddy, thank you very much. Great speaking with you. Appreciate you joining in with that perspective. The market, by the way, is up 23 points, 18,500.